Welcome to the October 2022 monthly MOTR checkup. My name is Dave Lundgren and I am the founder and chief market strategist here at MOTR Capital Management and Research. The topic of discussion this month is cyclical bear or crisis bear. This is an important distinction because if it's just a cyclical bear market, then we should be close to done. Most of the damage is in the rearview mirror and we should start to see indications of a bull market emerging here. If, on the other hand, this is a crisis bear market, then the argument can be made, and as I'll show, that we've only seen half the damage and that we have a lot more volatility and downside before this market finds a bottom and we can think about the next bull market. So let's start with a quick look at the risk gauge. This is a gauge that essentially combines trend, momentum, relative performance, and breadth across 4 different time frames. We feature this each week in the weekly MOTR report. And what I wanted to do today was just compare how the gauges performed throughout the correction in June and then where they stand today, and how that informs us that we are running the risk that this is something more than just a cyclical bear and it might be more like a crisis bear. So to begin with, when the market dropped 20% into the June lows, these 3 time frames of trend, spray, ripple, wave, and tide. So I'm just using the analogy that Charles Dow used to describe the 4 different time frames, or the 3 different time frames. I've added my own here, spray. Which is very short term. So think about this as being the daily, the weekly, the monthly, and the quarterly timeframes is a helpful way to think about it. But into the June lows, this spray time, the short term, along with these other timeframes, had all gone into risk off, signifying cyclical bear market. But also confirming that it was just a cyclical bear market was the fact this longer term risk gauge did not make it into risk off. And that's in our work how we distinguish between cyclical and crisis bear market. So that left us with a very oversold cyclical bear market, with the hopes that on the bounce and then the recovery that ensued from that oversold condition, that we'd be able to see some degree of improvement in all the charts that were broken on the way down to that 20% decline. So from June to August, we saw this massive run higher. 18% rally in the market, in the spray time frame, that daily time frame, went all the way back up to risk on, which is an important critical step in turning the tide from cyclical bear back to cyclical bull. So that's the good news. The bad news is that these 2 time frames didn't budge. They stayed in the risk off category, indicating that there was no meaningful repair work done on that rally. So in essence, what we did was we went from a very oversold downtrend to a very overbought downtrend, which is effectively the most risky setup that you can have. So when we fast forward to today, we all know that that the market failed at its 200-day moving average, and in so doing, the spray, that daily time frame risk gauge, went all the way back down to 10. So it's deeply into risk off, pulling with it the wave time frame 1 notch deeper into risk off. And then in something to be monitored here is that the tide time frame has notched one step lower as well, and it's now 1 step away from being in risk off, which to us, by our definition, would put us into crisis bear market, which would then set the stage for still further declines from here. So what we're doing here is we basically go back to 1929 and look at all of the declines by the S&P of at least 20%. And what we can do is we can bucket them into 3 different scenarios, if you will. The first scenario is the market drops 20%, but then it just keeps dropping. It doesn't bounce or anything. It just keeps on falling. The second scenario is the market drops 20%, but then it rallies back to the 200-day average and maybe goes back, goes through it by just a little bit, but then fails again and then heads lower again. These 2 here would be what we would consider to be crisis bear markets of different types. So just a crash basically, versus a more prolonged bear market. Crash scenarios end down 40%. The more prolonged bear markets end down 48%. And The other scenario of a 20% decline is that that's about it, and the market kind of bottoms right about there and stabilizes and then moves on to hit new highs again. That would be a cyclical bear market. So when we first took a look at this a few weeks ago, or maybe a month or so ago, in one of our weekly reports, we were unsure as to which one of these two would be the likely scenario, but we did know it because the market had gone all the way back to its 200-day average. We knew that at that point that we could eliminate this scenario simply because we went back to the 200-day average. So we at least knew that the crash scenario was not part of the consideration. But after the failure at the 200-day moving average here, we then drew attention to the 3,900 to 4,000 level on the S&P, saying that we'd be comfortable with anything, any weakness above that level in our mind would leave open the possibility that this indeed was a possible scenario. But as I mentioned on the prior slide, this whole rally did nothing to repair any of the damage that was done during this decline. So this left it as a relatively precarious support zone. It's not necessarily one that has an awful lot of support behind it, given the fact that the underlying structure of the market was so weak. And of course, we took that out. So that unfortunately leaves us with the scenario that we also have to lean with the evidence suggesting that we are not in a cyclical bear market, but are instead in some sort of a crisis bear market, which is now the sole remaining scenario for us to consider. If we were to look at all the 20% decline since 1940 and map them all on one chart, we'd have this sort of spaghetti-looking chart here with all of these scenarios, the individual periods sort of in the background in the gray. The yellow line is the average experience of all of them, and you can see how they're all centered here on this 100. They're normalized to 100. So here's your 20% decline, and then on average, this has been the experience. In those scenarios where you had a positive outcome, this has been on average the experience. And in the scenarios where you had a negative outcome, this has been on average the average experience. And so when you look at this, and as I indicated on the prior slide, this is showing that the current situation, which is in the blue, is mapping awfully close to the crisis scenario, in the sense that it's mapping very close to this sideways scenario versus a straight up affair if it was the beginning of a new cyclical bull market. It looks like we get a bit of a reprieve in here for a little bit, but ultimately a few months down the road is when we really pay the piper and that crisis bear really takes hold. So something to be very mindful of, in the sense that we're mapping very close to that crisis bear market scenario. And this is another way to really distinguish between a bull market and a bear market, and just how strong a bull is or how weak a bear is. So in our modeling process, we have a number of different models, but one of them is what we call relative performance signal, and it's basically just looking at the strength of a momentum rank, and you're basically taking all of the strong momentum stocks and you're bucketing them 1 to 10. 1 being the strongest, 10 is still strong, it's just the least strong of all of them. And then conversely, taking all the negative momentum and you're bucketing them into these 10, -1 being the weakest. 10 is still weak. You would definitely not want to be long that stock, but it's just not the weakest of the bunch. And when you step back and look at this table, what we're seeing here is looking at the average returns, either the average or the median, over the last 3, 6, 9 months in 1 year. We can see that even amongst the best ranked stocks, probably half of the returns have actually been negative. So these are the best performing, most consistently performing stocks in the entire 2,200 stock universe that we monitor, and roughly half of them have actually been posting negative returns over the past months to year. And then conversely, when you look at all of the ranks that are considered to be negative, the ones that are most attractive on the short side, if you will, or least attractive on the long side, you certainly wouldn't want to be long anything down here. What we can see is that every single time period, these relative performance signals have generated negative returns. So once again, that's the very definition of a bear market, where what's winning is barely generating positive returns, and everything that's losing is generating negative returns. So whether we're in a bull market or a bear market, of course, we're going to always want to try to hone in on where the relative performance leadership is coming from. And when we do that today, it shouldn't be too much of a surprise to see that a large contingent of what's leading is very defensive. So utilities, staples, financials, and healthcare. And the anomalous one here is energy. Energy is the only cyclical, deep cyclical sector that's actually in a leadership position. And what I find to be interesting is, as it's, what's driven this one rank is another way to think about relative performance is how has the average stock in each sector performed since significant swings in the market. So since the market peaked in December 31st, the average stock in the energy space is up 42%. And then it bottomed in March 8th. And then since then, the average stock is up 7.8. Then it peaked in March, and you can see the returns as you go along. Here's the June bottom. So with the market probing and testing around the lows, we can see that since that bottom back in June, the average energy stock is actually up 10.5%. And then really interesting is that since the market peaked in August, and we now know that the average stock is down 11% since then, the average energy stock is up 1.4%. So this is a really critical thing to think about as you think about mapping out your portfolio going forward, because oftentimes when you have these cyclical and crisis bear moments, the sectors or the industries that actually perform better than you would have expected given their traditional beta profile, like it's not surprising to see utilities and staples winning right now because they're supposed to do that in this environment. So you really can't say that that's potentially future leadership. But energy doing as well as it is throughout the course of this entire decline is a really strong indication that when things stabilize and when the next bull market ensues, and it will, that we really need to keep an eye on energy as being potential leadership for that bull market. And then you just look down here, all of these cyclical, growthy oriented sectors are at the bottom, and they've been doing terrible, throughout all of these various swings. I had recently pointed out real estate in one of our weekly motor notes. It's currently ranked number 10, and it's just doing horrifically across the board throughout these different swings. So once again, interesting that real estate might be twice featured in a crisis bear market, but that certainly seems to be the indication. To really drive home the point as to how fragile even the leadership is, I think it's helpful to actually use this risk gauge and look at each sector, look at the risk gauge for each sector to see how that is configured. So here, first of all, to begin with, just for comparison purposes, we have the overall market, which we featured on the first page, and we can see again the tide time frame is on the brink of crisis. Now this here is the energy sector, and you can see it's ranked number 1, and you can see this is very, very healthy. I mean, this is that long-term trend is very, very healthy, which is not surprising given the data that I just showed you, right? But it also shows you that how even in the short term some pressure can really be experienced even amongst the leadership. So just be mindful of that. But this to me would be a buying opportunity given this longer term context. We just have to sit through the fact that the market itself is undergoing such volatility that it might forestall any rewards for having identified this condition. But nonetheless, it's still, without question, it's the best sector. And then when you move over to utilities, this all drops to mixed. And this is the number 2 sector. Right? This is a number 2 defensive sector. Over to number 3 is staples, deeply into risk off, on the brink of crisis, etc. Here, financials in risk off, on the brink of dropping closer to risk off, and then of course healthcare is very negative in this regard. And now it's interesting when you look at healthcare itself, it's roughly in the middle in terms of the leadership pack. But when you look inside of healthcare, there's some very good charts and there's some very bad charts. So that leaves us with a relatively mixed picture for the healthcare space. But this is the leadership. This is what it looks like. It's not that robust. And when you just look at it this way, you can clearly see that we're not in a bull market. We know that, but we also can see how close we are to rolling over into something worse than what we've already seen. When we continue the analysis with the other remaining sectors, I mean, it just gets worse. So this is again in the order of relative performance. We have industrials, materials, discretionary, tech, real estate, and communications and media. And all of these sectors, except for one, is in crisis bear market. Every one of them. So this is the other tail of the leadership. And there is an awful lot of work that needs to be done here to get these sectors that are leading on the downside up and out of crisis mode. So this again is just more information to warn us that that the market itself might be joining this group of leaders on the downside in relatively short order here. In addition to leaning on the models that we've developed to track what's happening in the market, both top down looking at indices as well as from the bottom up looking at these 2,200 stocks and mapping each one and modeling each one to give us a sort of a bottom up amalgamation of what's happening in the market. So in addition to leaning on that process to help us understand what's going on, we also look at a lot of the traditional metrics as well, and here's a few of them. So Bitcoin itself has become a bit of a risk on, risk off asset, and looking at high beta versus low volatility and discretionary versus staples, you can see how these relationships ebb and flow with the market. As the market goes from bear market into bull market, these tend to coincide with those changes. And so we already know from what I've shown so far, vis-a-vis my process, the model, that trend following, momentum, relative performance, and breadth, all amalgamated into those risk gauges. We already have a bearish inclination for that reason. But then we just get, when we pick our head up and look at the rest of these indicators, we can see that we're just getting further confirmation that there's work that needs to be done here as well. They're all in downtrends. This one here might be getting a little bit better. This is discretionary versus staples. We want to be a little mindful of what's going on in this calculation, simply because it's cap weighted, and there's other influences that might drive this particular development, but nonetheless, this is the best one. So it's at best at this point maybe decelerating in its downtrend. It certainly hasn't reversed into an uptrend yet. So when you look outside of our own modeling process, we get confirmation from traditional analysis as well that the market is indeed still in a precarious state. So as bearish as the environment might be in any given moment, when you get very oversold or really compressed in momentum, there's still, even as bearish as it might be, there's still a tendency for the market to rally. So, I'm recording this on a Wednesday, and on last Friday, there were 2% of the S&P 500 stocks were above their 20-day moving average, which you can see here. So in that scenario, you should anticipate some sort of a rally. It's the same thing that we had back in June, which you can see here. And the main thing to pay attention to is, on that rally, do you get any repair work? So here we are. It's on Wednesday. We've rallied quite a bit. I think we're having a bit of a pullback here today, but nonetheless, we should expect a rally. That's not the point. The point is what happens on that rally. But just to summarize this for you, just if you break the buckets down by percentage of stocks above the 20-day average, so this bucket here would be 0 to 10% of the market is above its 20-day average. So that's very, very compressed and oversold, and that's where we are right now. If you look forward over the next 1 week, month, 3 months, and 6 months, you can see it's the best bucket of returns going forward. And that's true, and that's something that you should anticipate even in a bear market. You should expect some sort of a bounce. But the problem is that when you have these crisis moments, these oversold conditions, yes, they result in a bounce. There's no doubt about it. But the problem with them is that they don't do any repair work for you during those bounces. And so they just end up going from, as I said earlier, oversold downtrend to an overbought downtrend, which again is ultimately the most bearish setup you can have. So yes, we should anticipate some sort of a rally in here. What's most important is, can we fix any of these broken charts on that rally? We've already demonstrated that we couldn't on that last rally. The problem is that since then, we've actually done even more damage. We're even closer to a crisis bear market. So I think it's just even all the more reason to exercise caution and be patient. As I wrote in this past weekly MOTR report, let's just wait another week before we make any big changes to our allocations, simply because the pressure is so great on the market that we're just better off waiting for the data to change. So let's just be a little patient and see what happens over the course of the week, see if we can make any changes to the underlying structure of the market as a result of this rally, should it persist. Before we go on, I did want to just point out to note that when you have 90 to 100% of the stocks are above their 20-day moving average, that, by the way, is the second best forward-looking return scenario. And that's important because eventually we're going to get this again. And if we can see other indications of trend change, and then we get a very overbought condition like that, we're going to want to go with it. But I want to point it out now because you'll see that right here, we did get an overbought condition that was in the 90s here. And of course, it was well known, it was well discussed. We discussed it in our research. And what's different between a bull market and a bear market is these extreme overbought conditions get sold. They don't result in what you would typically find, which is further strength. They actually get sold. And the last one we had clearly got sold. And so we want to be mindful of that as well. Of course, the challenge is that if you're defensively positioned, and even worse, if you're short stocks, which those that should be short some exposure here given the conditions. But the challenge is that as the market goes back and forth between these overbought and oversold conditions, there's always pain. The market always causes pain, no matter what type of an investor you are. If you're a passive long-only investor and you're just accepting whatever the market delivers to you in any given day, week, month, year, or whatever, obviously right now you're experiencing a lot of pain. So for tactical investors, those who try to navigate and circumvent and get around those cyclical and crisis bear moments, even though we've been able to stay out of the way of this bear market, we still experience pain. So as we're defensively positioned and the market rallies 10 or 15%, we're not there, and so we end up experiencing the pain of not being there, not capturing that gain. But again, the reason we do that is because as we've defined the structure of the market, we don't think those kind of rallies have the underpinning strength to last and sustain themselves. So the odds are greater that after that rally is over, you go to new lows again. And we think that that's the case today still, but in the interim, we experience a lot of pain. So I wanted to share this quote from John Lewis. We had just finished recording the episode 22 Fulfill the Gap podcast, which is the podcast that I record and host for the CMT Association. And in that interview, John Lewis said that there isn't any alpha to be had in strategies that you always feel good investing in. Being uncomfortable at times is a necessary evil. So that's the main takeaway for this slide. Just be mindful that no matter who you are, you're going to experience pain. Our pain as tactical investors that are presently defensively or bearishly positioned is that we might even go down if the market goes up because of our short exposure. But that's a pain that we're willing to endure in order to forego the bigger pain of having to endure 20 to 50% declines in market value. Okay, so let's put all of this into a bit of historical context. This chart is looking at the inflation-adjusted S&P since 1940, and obviously, given what's happening with inflation, this is probably a relatively important way to look at things today. But what I wanted to point out is how the inflationary trends, they cycle through this pattern, if you will. They go from reflation, so that's coming out of deflation. So you reflate the economy, which is good, and then you go that reflation spills over into too much reflation, which ultimately turns into inflation, which is bad for stocks. And then obviously the world thankfully has the leaders like Paul Volcker, who back in the 80s broke the back of inflation, ushering in a disinflationary state, which was very good for stocks. Of course, that disinflation spills over eventually into deflation, which becomes bad for stocks. And that deflationary period prompts the central bank to do what it does to try to rekindle and reflate the economy, which clearly we're back in that mode right now. And some would argue easily that the reflationary impulse we've experienced since the global financial crisis is of epic proportion, something we've never seen in history. So what does that mean? So if we go into crisis bear market from here, we run the risk of breaking this uptrend that's in place since the beginning of the reflationary period. When you break these trends, that ushers in the next phase. So in this case here, because we're coming out of reflation, that would be comparable to breaking this trend here as we're going into inflation. And the main thing to take away from here is that equities as an asset class tend to do well during reflation. They tend to do well during disinflation. Where they don't do so well is inflation and deflation. Now this is only 2 instances, but what we can see here is 63% real inflation adjusted decline and a 62% real inflation adjusted decline were the outcome of the last 2 alternating cycles. So the importance of not going into a crisis bear market from here cannot be overstated, because if we do go into a crisis bear market and we end up going down, which would be the average of 40 to 50% off the highs, which is basically in another cyclical bear market from here, we at that point run the risk of breaking this reflationary uptrend, which ushers in an alternating cycle of inflation in a really difficult time for equities. It doesn't mean that equities can't be owned, but as an asset class, it'll be a headwind, and those that are fishing in the equity pond will certainly be swimming upstream, if you will. We won't have the tailwind of reflation or disinflation at our backs. So there'll always be stocks to be long, but this just would be one more reason why I'm glad that I'm not a passive long-only investor, and one that is more tactically oriented and regime aware, if you will. So if you're looking for good news on the inflation front, we can certainly provide you some here. This is the inflation expectations on the 5-year time frame, and we can see that they've actually peaked. They peaked back in the second quarter, and so that is an indication that the market, at least fixed income investors, are a whole lot less worried about inflation than they were several months ago. Having said that, and sort of a bit of an offset to that good news, is that the 5-year Treasury note yield has continued to skyrocket, and the corporate OAS option adjusted spread, which is basically an indication of stress in the corporate market, has continued to rise as well. So these two things, the OAS spread and the 5-year yield, suggests that the fixed income investors are worried about something. This blue line, inflation expectations declining so rapidly, suggests that that it's not inflation. They're worried about something else. Of course, as we always say in the trend following space, we'll find out later. What we know now is that trends are bad, and that's pretty much all we need to know. We don't need to have an opinion about it, but this is certainly an interesting disconnect taking place in the fixed income markets, and I'm sure it's something that we will be able to explain with ultimate clarity in a few months. And of course, to add to the confusion coming out of the bond market, this is another proxy for inflation expectations, which is easily calculated by dividing the TIPS ETF divided by the TLT ETF. So the TIPS is the Treasury inflation protected Treasury. So this tends to outperform when inflation expectations are rising. And so just taking the TIP and compare it to the TLT when this is rising, the TIP is outperforming, indicating that inflation expectations are for higher inflation. So we have a bit of a disconnect there. Having said that, it's also interesting to note, you'll note how these two lines here tend to follow the red line above. And there's a reason for that. The blue line is equities that tend to benefit from rising interest rates. So there's just a basket of stocks that tend to do well when interest rates are going up. And it's just the relative performance of that ETF that you can see here. And so this tends to rise when inflation expectations are rising. And this one here is a basket of stocks that benefit with rising inflation. And so it's not surprising to see that these tend to move in the same direction. And it's just interesting to note that as of now, at least, these two ETFs outperformed into the bottom in June. And now that we're back at the bottom again, these two ETFs are not outperforming, at least to the magnitude they were then. So a lot of disconnects going on there, and that's very typical of bear markets. There's very, very rarely do you have much clarity beyond the fact that it's a bear market, and the day-to-day swings and the week-to-week swings are very confusing, which is why we choose in moments like this to just really gross down exposure and just try to take more high conviction bets and make them smaller and wait for things to settle down. So this slide helps us take this conversation all the way down to the portfolio level and get a sense for how we should be positioning in this, what is clearly a bear market environment. So this is our momentum score. This is a score that just takes into account the various time frames of momentum and buckets them into decile. And then what we're doing is we're just drilling down into each decile to see what's in it, what's actually in that decile. And we find that in that top decile, the biggest contingent is energy. And then the second biggest one is healthcare. Now, if we can conduct that analysis all the way across the top decile, so this is 80 to 90, 70 to 80. And what we can then do is also say, what if we add up all of these and just say 50 to 100 rank, what's in that entire bucket? We get a sense for what's in that bucket here. And when you look at this exposure here relative to the sector's representation within the market, the broad market, you get this column over here. And that's how this whole table is sorted. So in this leadership bucket, energy is 5% overweight, then utilities, financial, staples, materials, etc., all the way down. And you get down to, where we really want to see leadership turn and develop, of course, is tech and discretionary and communications and media, industrials. We can see that, these are all at the bottom. So just further confirming the idea that the things that you would typically see leading in a bull market are not. I showed you the risk gauges for each sector, and they're all the ones that are hanging out down here in the bottom leadership rung are in crisis mode. And let's not forget that they're in crisis mode. So there's a lot of risk in this market. So how do you take all of this back to portfolio positioning? If you're a long-only portfolio manager, the conclusion is to hold the maximum amount of cash that you can have, and then within your exposure, favor low volatility, quality, and defense. But don't lose sight of this energy sector. I think you should have some exposure there to energy as well. It's just too strong in what is otherwise a clear bear market. So that's an important message going forward for future leadership. If you're a long short, like I am, you should have low gross exposure overall, because we're still trying to make the distinction here between cyclical bear and crisis bear, because if this does end up being a cyclical bear, and we're open to that, it's just the data doesn't support it, but it could happen. This is obviously a terrible time to have significant short exposure on, especially with the market as oversold and compressed as it is, or as it was as of Friday. So this is not a time to be making big bets, so low gross and a relatively close to neutral exposure. And then let positions evolve from there based on which roadmap the market really chooses from here. So the big takeaway is to just be patient, let the data unfold. There is, if we're in a strong bull market and it's the worst sectors in the market are still posting positive returns, and that kind of thing, where you have a very strong bull market, I'm very happy to be buying weakness in that environment. This is not that environment. This is not an environment to buy weakness. This is an environment to be patient, let the data come to you. Like I said in one of my notes, in one of the titles of one of my weekly reports was that, good markets pull you in, whereas you force yourself into bad markets. This is a bad market, and trying to force yourself and try to force things to happen just because maybe it's what we want to see and what we prefer to see is really setting yourself up for a bad outcome. I think you just need to be patient and let the data unfold. There's a lot of risk still in this market, and I think let's just follow this week to week in the weekly MOTR reports, in these monthly videos, and hopefully things will change, and we'll detect it in our process, and we'll report it to you when we see it. So thanks for listening, and keep in touch. If you have any questions, shoot me an email, and looking forward to further communication with you.